Dealing with the Unexpected. Presented by Sat Parashar, Ph.D., Finance. Independent insurance advisor and broker. Email: financialguide01@gmail.com. This is intended to be educational only. It is no news. Life has many risks. Some risks are unexpected and can be downright devastating. You insure your car and home. Life is certainly more valuable than the car and home. A person earning $100,000 annually at age 40 have potential to bring home income of minimum $2.5 million for his or her family and loved ones. This person in a sense is the dollar printing machine of his or her family. To deal with the unexpected, whole life is the better way. Let me present a high-level summary. Some advisors like Dave Ramsey would recommend term life insurance over whole life insurance, with a famous slogan, "Buy the term, invest the rest." Let me first share with you the features of term life insurance and whole life insurance and then show you holes and gaps in Dave Ramsey's wisdom. 3 main features of term life are: 1. Covering risk of death. 2. Acceleration of death benefits in the case of critical or terminal illness. 3. No event during the term, no claim. Your premium washed, zero return. 3 main features of whole life are: 1. Covering risk of death. 2. Accumulation of cash value which can be withdrawn for any use including investment in business, down payment for home, college education, supplemental income in retirement, meeting illness expenses, endowments, charity and gifts, no questions asked, no strings attached. Number 3. Assured return of premium plus growth, and premium never washed as in term life. Do you notice whole life as term plus plus? It is death benefit plus living benefits plus assured return of premium with growth. Should it cost more? Remember it is higher cost for higher and certain benefits. Certainty in financial markets is highly valued. Research shows that in government securities market, a price-earnings ratio of 70 is common, which means for an assured return of $1, people are ready to invest and pay $70. Now let me turn to buy term, invest the rest, and bring up the real side of it to you. First question: invest where? Bonds, stocks, real estate, commodities, foreign exchange, cryptocurrencies. Americans love stocks. 55% of them invest in stocks. Argument 4. Invest in stocks. Average return 10% or higher for nearly the last 100 years. Now do you those holes and gaps in 10% return over the nearly 100 years argument. You are talking return over nearly the last 100 years that is equal to 4 generations of 25 years. The return talked is based on stock indices and not actual realization. The return does not mention a single word about volatility, standard deviation, of the average return, and possible downside losses including wiping out of a substantial investment. In reality, where do many of those 55% invest? Some index fund, which is actually zero investment play. It is passive. It is certainly good for index funds. Don't cover and substitute risks of life with risks of investment. Don't fall for lower or cheaper premiums. Know and compare costs and benefits. That is smart. For any questions, please contact Sat Parashar, Ph.D., Finance. Insurance advisor and broker, for life, health, disability income, long-term care. Email: financialguide01@gmail.com. Thank you for your time.